Hycroft mining has given us an amazing run over the past couple of weeks, and now we're potentially going to see even more bullish momentum from it and generate amazing gains for the shareholders. In this video, we're going to talk about Hycroft Mining Corp, trading under the ticker symbol HYMC. At the moment, the financial market is very volatile, and we should be careful about which stocks to pick, as well as the exposure and the timing of our positions. This video will cover the recent price actions and the technical aspects of the stock. A quick heads up before we start. Usually, I cover stocks based on trading sessions already completed. This video will take an exception on that rule and cover the stock live as it is happening. If the closing price is different from where it is right now, depending on how big the difference is, I will make follow-up videos to reflect those changes. With that being said, let's jump into today's topic. During the most recent trading session, the stock increased to around $2.25 levels. We should definitely pay attention to the $1.50 level nearby because it was tested as a support level that was able to hold the price for at least 3 times over the past few months. And that is probably the most significant support level that is available to HYMC for the moment. Over the past 30 days, the trend of the stock is clearly bullish, as it is creating new peaks as we speak, and this tendency will only be emboldened even further by new demand that is probably going to pour in over the next couple of trading days. From the perspective of a longer time frame, which is 6 months and above, the trend of the stock has been bullish with high price volatilities, lows going to the penny stock levels, and the highs at times peaking 500 to 600% over a few days. When we look at the price trend overall, it's been speeding up because the market is now turning its tide from a generally bearish context to a much more bullish stock. And this is amplified even further because this company is a small cap. The trading volume of Hycroft Mining has recently been 190 million shares versus the average volume of 96 million shares. Over the previous 52-week period, its price fluctuated between 28 cents and $4.37. The market cap of Hycroft Mining is currently at $77 million, compared to the enterprise value of $230 million. The difference between the market cap and the enterprise value is the premium or discount the financial market is willing to allocate to the company based on its current fundamentals, leverage, and asset composition. The enterprise value is the combined value of the company's assets minus the debts. If the company has a lot of debts or has a negative image amongst investors, the asset's value may be impaired. With that being said, at the end of the day, it remains an estimation of the market every time it publishes its financial statements, so it's less reactive than the market cap and often more lenient as well. One key element to note regarding the enterprise value is that for many growth-type companies, one of the most significant assets they own is the Goodwill. Goodwill is an expectation of the market that the company can generate more profit or grow faster than its rivals, partially because it may be assumed to have a better management team, a stronger brand recognition, a bigger online following, and so on. It is what makes this company in particular unique. In other words, it's not a tangible asset that companies may use, but it's often the reason why some companies are perceived to be trading at a discount, because the market cap is lower than the enterprise value, and the enterprise value is less reactive to the market cap in very volatile situations. If the company goes to liquidation, there won't be any goodwill left, and the shareholders and bondholders are going to be sharing amongst each other whatever that is left after the goodwill is depreciated, along with many other assets that would be potentially depreciated as well. When we compare the current price to the historical price fluctuations, the stock is 573% higher than the 1-month low, 573% higher than the 3-month low, and 573% higher than the 52-week low. On the options market, which gives us a hint about the market sentiment, the implied volatility is 265% versus the historical volatility of 458%. The put-call volume ratio is currently 0.07. It's normal for many stocks to have a higher put option volume than what they deserve because many institutional investors hedge their long positions by buying put options. The most recent volume of options traded is 73,000 contracts versus the 30-day average of 24,000. Regarding the open interest, the most recent volume of open interest is 119,000 contracts versus the 30-day average of 52,000 contracts. For the shareholder structure, institutional shareholders own about 18% of the outstanding shares. The biggest shareholders include White Box Advisors, Nomura Holdings, and Vanguard. It's relevant to understand the shareholder composition of a company as it helps us to determine if the stock should be considered as a long-term holding or to view it as a trade opportunity. If the stock is mainly held by retail traders, this can be a sign that the stock lacks the depth to justify long-term trust from shareholders. The consensus is between 25 to 30% of institutional participation for the stock to be perceived as a sound investment and not just a short-term trade. Obviously, there's a lot of exceptions to this since many great companies are also held by retail investors, but that tends to be the exception and not the rule so far. Let's also take a look at the short interest present in the stock, which is the amount of positions aiming to profit if the share price falls lower. Sometimes there are significant short interest in the total volume, and this can be a sign of something more organized going on. The current short interest is 15% of the total volume, and many of that happens outside of the exchange. 46% of the transactions are also coming out of the dark pools. Overall, my opinion on Hycroft mining is bullish because the stock is having enough demand for an ascending trend, and that the overall environment is now more favorable for the stocks that are relatively more speculative in their nature. So the maximum exposure I would recommend is between 1 to 3% of your portfolio, and for the immediate term, my recommendation is to buy the stock, considering that the recent price actions and the promising price levels that are very close to where the stock is right now. I would recommend to separate the allocation in batches of 20% at a time so that you can have enough room for later purchases. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth type equities. The financial market has been living and breathing thanks to the continuous creation of new capital with different waves of quantitative easings, which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect in investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance, since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, if your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks with the expectation that they will be loaned to businesses. Normally that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up, or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, capital is always looking for a safe haven to park their money into. not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, when it comes to the price trends of the market, the degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach, which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.